Hello, this is Professor Don Bush from Accounting Superstars. Hope you're doing well and you come to the right place if you want to learn accounting. I've been a professor for about 30 years and a CPA for about that long. I've got great ways to explain accounting. And let's get started. Today's lesson is the accounting cycle. This is something really valuable to learn. So this lesson's designed for people that are probably in their fourth week of accounting class, principles of accounting, their beginning accounting class. And it really helps a lot to know where you are in the accounting cycle. So that way you understand, well, how it relates to what's going on with accounting. And so anyways, a lot of people say, oh, why do I need to know the accounting cycle? I'm a marketing major or I'm a management major. Now, you management majors, you'll be managing the accountants and someday, and it's really hard to manage something if you don't understand what's going on. All right, so it's good to understand this. It's not that hard, and it'll help you in your accounting class too. All right, so here we go. So what is the accounting cycle? So here's what's going on. The steps that are highlighted in this pink color happen during the month. They happen all month long, every day during the month. So step number one, something happens. Kind of technical there, huh? So something happens, for instance, like cash changes hands, or the workers are doing some work, or the company is delivering a product or receiving a product. So something happens that needs to be entered into the accounting records. Now there are examples of things that happen, but don't go into the accounting records. For instance, suppose that you hire a brand new worker and say, hey, you're hired, you'll fit in great, and we'll have you start in 2 weeks. Well, the fact that you hired somebody is important, but it's not going to get entered into the accounting records. And there's other examples too. So you have to be careful. Only certain things. Certainly anything that involves cash gets entered into the accounting cycle. Anytime you earn money or consume resources, those are always entered into the accounting records. So here you go. The next step here, this is where the accountant comes in. Here I've got a picture of an accountant right here. And since this is highlighted in a pink color, this is happening all throughout the month. So we need to journalize these transactions. So journalize receiving money or paying out money, and journalize the workers doing some work, and journalize delivering a product or receiving supplies. So here's just an example journal entry. In this journal, it's called the General Journal. This General Journal is a chronological listing of the things that happen in the business. So if the boss asks, hey, last Tuesday, did we receive money from that customer last Tuesday? You could look in the general journal and figure that out. Or, hey, didn't we pay the rent on at the end of the month on September 30th? You could look that up in the general journal too. So it serves a very important function. Now, coming down to the third step, we need to post these transactions into the general ledger. Now, a lot of brand new accounting students feel like this is busy work, that it's not important. And we already recorded the transaction, so why do we need to enter anything into anything else? Well, the ledger serves a completely different purpose. And I've got arrows pointing from this example transaction here, this journal entry, and it shows that this information flows down into the general ledger. Now, the general ledger answers questions like, well, how much cash do we have right now? Or, hey, how much does our customer owe us? Or, gosh, what is our debt to equity? Those kind of things. So it can answer questions that cannot be answered just from step number 2, the general journal. So here's a picture of an old general ledger, and I'm old enough to have experienced this. I started doing accounting just before computers started doing accounting, and I used to use these old ledgers, and it was a big pain when you'd make a mistake and you'd try to find out where the mistake was, and of course you'd have to write this all in ink because you didn't want people to have the ability to use their pencil eraser and erase transactions and whatever. So So it was difficult back then. Computers have made it a lot easier. So this general ledger, I've got it illustrated here, but with T accounts here. Like I've got a cash account and a revenue account, and that's probably just two of many accounts. There'd be a lot of expense accounts and asset accounts and liability accounts. The general ledger consists of all the accounts in your business, which can range from 20 to 30 to several thousand. Many years ago, I saw the books for Mitsubishi Company, and they had thousands of general ledger accounts. It was unbelievable. So coming down here to the next step here. Well, the next step I've got in blue here, kind of like a grayish blue. And that is because we only do these steps at the very end of the year. At the end of year closing or the end of month closing, depending on how often the company does the financials. With small businesses, I usually did them always on a monthly basis. So this would be done at the end of the month. So step number 4, what we do is we make a listing of our general ledger accounts. These things right up here, these general ledger accounts. And we want to make sure that the left side equals the right side. That is, debits equal the credits. And you probably remember that debit just means left and credit means right. So we just make a list of all the accounts and we put the balance either as a debit or a credit as appropriate. And we want to make sure that it balances. Now this step's pretty important, and it used to be really super important back in the old days, back when this was done by hand. We want to make sure that our debits equal the credits. And if they don't, there's no sense in going on. We will not find the mistake if we go on. What we have to do, if our trial balance does not balance, we've got to go back and we got to trace what we did. We have to start with, okay, did we record the transactions correctly? Did we post to the ledger correctly? And did we add up these accounts correctly? And did we get every account? Now, nowadays, this is really easy because computers do most of this. In fact, nowadays, going back up here to step number 2, with computers won't allow you to enter in transactions that don't balance. The computer will make sure that your debits and credits balance. And if they don't, your computer will beep at you and give you an error message and that kind of thing. And then the computer automatically posts to the different accounts. So there's usually not mistakes done in that area. And then all you do is press a button and the computer will provide a trial balance. So this trial balance, it's not as important as it used to be, although we're going to use this trial balance to help us with the next step. So I guess it's really important in that respect. So here we go. So what we're doing is we're looking at this trial balance, and it's at the very end of the period, at the end of the month or the end of the year, and we have to do adjustments. Now, adjustments don't mean that we made mistakes and we have to fix mistakes. But what we are doing is we're adding things into the accounts that were not taken into account of during the month. For instance, here's a really great example: depreciation expense and accumulated depreciation. We are recording depreciation. And if you look at this trial balance up here, it doesn't have depreciation expense or accumulated depreciation, but we're going to do that in the adjustments. And there's many other adjustments too. There's interest that is accrued, wages that is accrued, using up insurance, prepaid rent, unearned revenue. These are things that you learn in about the 3rd chapter of your accounting class. And it's not an easy chapter either. These adjustments are probably the trickiest thing of all. And these are the items that still require some brain power here, even though we're using computers to do most of this. So in fact, this is when I did accounting for small businesses. This is where I came in quite a bit, doing these adjusting entries, because they're difficult and you have to have quite a bit of training to do them well. So here we go. So here are these, and usually for most businesses there are several adjusting entries, and I just am showing one here. Now the next thing that you need to do is take this adjusting entry and post it to the ledger just like we did before. It's no different than what we did before. So, like in step number 2, when we had a transaction, we posted it into the general ledger, this old book right here. And of course, now it's all done on computer. And so it's the exact same process, no different. So we're taking this adjusting entry and we're posting it into the general ledger. Now, once we get all those adjusting entries done and posted into the ledger, we're going to make a list a second time. And it's called an adjusted trial balance. All right, so it's just a trial balance again, and we're just making sure that the debits and credits balance. And with using computers, they're always going to balance. But back in the old days, this was a really, really important step. So we have this adjusted trial balance, and we can go back and do more adjusting entries if necessary. But once we're satisfied with this adjusted trial balance, we'll go down and produce the financial statements. And nowadays, this is a really easy step. All you do is press another button and the financial statements are printed out. But the financial statements include things like the income statement, the statement of changes in owner's equity, and the balance sheet. There's also another statement called the statement of cash flows that you probably have not studied very much up to this point in your accounting education. So once the financial statements are done, that brings us down to the closing entries. Now, the closing entries are super, super simple. They're the easiest thing in this whole accounting process, but students manage to mess it up. All right. And I don't know why they mess it up. It's the easiest thing. The only things that you close out are accounts that are on the income statement. So let's go look at the income statement here. So here's a little tiny income statement, revenue. We've got expenses. In fact, those are the only two things that go on an income statement at this point in time. Revenues and expenses, that's it. So we're going to close out. The revenue and expenses. That's it. We are not going to close out cash. We're not going to close out owner's equity. We're not going to close out equipment. We're not going to close out anything else. The only thing we're closing out are revenues and expenses, income statement accounts. So here's what you do is you debit revenue. You might say, well, why do we debit revenue? Well, revenue carries a credit balance. So to close it out, we need to debit it. All right. And you might say, well, how'd you know it was for $120? Well, I knew that because that's what's on the income statement. All right, so on this income statement, we have revenue sitting here as a credit balance. So to close it out, we simply debit it. Just do the opposite and it closes it out. And here's depreciation expense and wages expense. So let's get those off of the income statement. Depreciation expense, $10. Wages expense, $70. So you just bring them down here. And there you go. Now, how did I know to put them on the right-hand side as credits? Well, expenses usually carry debit balances. So to close it out, we need to credit it. Wages expense has a debit balance. So to close it, put it on the credit side. Now, our journal entry won't balance. And so what we do is we use owner's equity to make it balance. So owner's equity, and I misspelled owners. We credit owner's equity here to make it all balanced because 10, 70, and 40 add up to 120. So our journal entry balances. Now, once we have these closing entries completed, what we do is we post them to the general ledger. It's the same old general ledger as before. It's the same one back in step number 6 and step number 3. All right, same old document. So what we do is we take the closing entries and we just post them into the accounts. There you go. And you can see that revenue here started out with a credit balance of 120. The closing entry is a debit for 120, so it's closed out to 0. And the same sort of things going on with depreciation expense. Depreciation expense started out with a debit. So to close it, we need to credit it. There's my credit right there. And that brings it to 0. And if you notice one more time here, only revenues and expenses are being closed. Nothing else. Do not close cash. don't close accounts payable. In fact, a good rule of thumb here is don't close anything that's on the balance sheet. All right. If it's on the balance sheet, don't close it. All right. Because it'll just be wrong. There you go. So lastly, step number 11, we start over again. That means we just go back up to the top. And here we go. So we start the brand new month fresh, or the brand new year fresh. Something happens. We collect cash. Workers do some work. We deliver products or receive products. We journalize it, and so on and so forth. So I hope this lesson helped you out. This is something really valuable to know. And the sooner you memorize it, just memorize the steps. That way you'll know where you're at in the accounting cycle, and you'll know what's coming up next. You'll know why you're doing it. And there you go. Be a lot easier for you. Hey folks, I've got a brand new website here called accountingsuperstars.com, and it should be up and running today. I think that's what they're telling me. So accountingsuperstars.com, and what I've done is I've taken all these videos, every one of them, and I've listed them out by topic. So that way you can look up topics that you're interested in, topics that you need help with. So let me know how it works. Leave a comment below, and let me know what topics are giving you a bad time in accounting, and I'll help you out with that. And hit the like and subscribe button so that way YouTube will show these videos to people. And until then, over and out.